Thanks, Peter, and good morning, everyone. Now looking at the roaring 20s and specifically the outlook for equity markets and where the parts of the market that we think are attractive right now on a forward-looking view for the next 5 or so years. If we look at the last 12 months, we've been from the depths of despair and recession in Australia and globally, and we've seen a very strong recovery as both fiscal and monetary stimulus has flooded markets and vaccine rollouts across the world are starting to allow economies to reopen. And so what we're seeing with the combination of vaccines and stimulus is effectively a resetting of the economic cycle that should lead to very strong economic growth. We expect that in the US this year, real GDP growth could be as high as 7%, which has really moved away from that recessionary period that we saw 12 months ago and towards that strong recovery. And you could even classify 7% as the kind of economic growth that you would see in more of a boom time. And so we really do expect that strong economic growth to come through over the next 12 months and beyond. One of the outworkings of so much stimulus in markets is inflation, and we do see some inflationary pressures, but we do think that they are the risk around inflation is manageable, and we don't expect to see central banks, or at least the Federal Reserve in particular, tightening this year or next year, and it's likely going to be late 2023 before we see at least the short end of interest rates rise in the US. And so that while we might see some short-term inflation upside, we don't expect runaway inflation, and so that's not a risk that we are extremely concerned about. The record US stimulus and fiscal stimulus, trillions of dollars worth being pumped into markets and the economy, is expected to lift global GDP by over 1% over the next 12 months, according to the OECD. And finally, alongside all other markets and economies in the world, Australian GDP growth is set to recover this year, but we do expect to see that recovery be lower relative to other markets. And that's really just a reflection that this time last year, the economic impacts to Australia were not as severe as many other global markets in the downturn from the initial impacts of COVID. So given that backdrop, where we see the most attractive asset class at the moment and looking forward into the next 5 years of what will be the roaring 20s, there's a preference for equities over bonds, and within equities we favour non-US equities over those in the US. That early cycle economic environment, as I mentioned, lots of stimulus, relatively low inflation with some upside, and relatively low interest rates, even though interest rates are expected to rise modestly, particularly at the long end. We don't expect extreme rises in interest rates, and so inflation and rates should be kept under control. That will support markets and particularly equity markets. And over the next 5 years, we expect equity markets globally to return over 7% relative to bonds, which we expect to be a small negative return over that same period. Within equities, however, we have a preference for more cyclical exposures, and that leads us to exposures in the rest of the world outside the US, and we expect rest of the world markets such as Europe and Asia to post double-digit returns relative to the United States, which will be mid-single-digit return or thereabouts based on our expectations. Our preference for non-US equities over US equities and our preference for more cyclical stocks is consistent with our preference for value stocks over growth stocks. Over the last few years, we've seen strong performance of growth and underperformance of value, which really culminated in a blowout outperformance of growth in the first half of last year due to the exposure to the stay-at-home theme, whilst value stocks that were more cyclical underperformed whilst the economy went through what was a very rapid recession in effect during Q1. Now that we've seen that economic reset in the cycle, we believe that value stocks across the globe are quite attractive, and we assess this based on our investment framework of cycle, valuation, and sentiment. Looking at cycle, as I've mentioned, the economic outlook is quite strong, and that should support cyclicals. The outlook for earnings is quite positive, as well as leading indicators and manufacturing indicators, for example, global PMIs. And we expect that will support cyclical stocks over the next 12 months and beyond. Notwithstanding the recent rally from November to today, once there was an announcement of a successful vaccine, value stocks remain cheap, both on an absolute and relative basis, so we like the valuation. And finally, sentiment has recovered. If we go back 12 months, to the end of Q1 2020, markets had fallen 35 to 40%, cyclicals had underperformed, and the sentiment around value stocks was quite poor. We've now seen that sentiment recover, and value stocks are beginning to show positive momentum, which is quite positive. So based on our investment framework of cycle, valuation and sentiment, we're now seeing 3 green lights, which we view as very positive in terms of the outlook. Looking at the 2 charts here, on the top I've shown the valuation of value stocks, and you can see that below the red line is 1 standard deviation cheap. Notwithstanding a recent rally, value stocks are still cheap relative to the market and trading below their historical discount. And this is similar to what we saw coming out of the GFC. On the bottom chart, you can also see our measure for sentiment for value stocks, and that has now recovered, as I mentioned. And so value stocks starting to exhibit positive momentum is quite a powerful force, and we expect that that will continue to push value stocks to outperform in the coming 12 months. So looking closer now, closer to home, Australian equities is a market that has lagged relative to global markets this year, but we still find attractive segments of the market that reflect our value view as well. And one part of the market that we like is the banks within Australia, and we can apply our cycle valuation and sentiment framework to the Australian banks in order to assess that attractiveness. So looking at the cycle for Australian banks, of course, the RBA has kept short-term rates very low and will continue to do so. The housing market is quite strong. That's something that is quite well reported on. We're seeing increased business confidence and the strong economic growth, of course, that is now across the world as a result of broad stimulus, vaccines and economic reopening, should lead to a steeper yield curve than what we've seen before. And that steeper yield curve allows the banks, should allow the banks over the coming years to earn a higher net interest margin relative to what they've earned in recent years where bank performance has been relatively lackluster. Bank valuations remain attractive. Again, notwithstanding recent rally, banks remain cheap and remain below their post-GFC average valuation. And also, when looking at the banks through a dividend yield lens, there is a 50 basis point pickup, or 0.5% pickup relative to the Australian market on dividend yield. The bank's now paying an expected yield of around 4% before the impact of franking credits as well. So looking quite attractive on valuation. And finally, the sentiment for Australian banks has become quite positive with recent outperformance, and that is similar to the positive momentum being exhibited by global value stocks that I mentioned earlier as well. Here you can see the Australian bank valuation being charted through time, and I've shown the post-GFC valuation based on price to book, which is a common measure of bank valuations, the orange line showing the average. And whilst bank valuations have recovered, we do still believe that bank valuations are cheap, and you can see that the price to book remains below its post-GFC average. And so notwithstanding that recent outperformance, there's positive momentum, valuation is cheap, and we believe the fundamentals are attractive. And so now we believe the banks as a whole are an attractive part of the market. Russell Investments' 2 ETFs, RDV, which has an income objective, and RARI, which also has an income objective with a responsible investment universe, both have value tilts in the portfolio because of that income objective. Both ETFs have overweight positions in the banks, and we believe that this positioning will be rewarded in our base case, as I've just laid out, a base case favouring cyclicals in an environment where economic growth is continuing to be strong. Both of our ETFs were reconstituted at the end of March, and as part of that we saw increased cyclicality added to the portfolios through select positions, mostly in the materials sector. In RDV, our dividend income portfolio, we continue to favour banks and select materials stocks for yield. New positions in mineral resources and Rio Tinto were added at the end of March. Rio Tinto is trading on an expected dividend yield of close to 10%, the elevated iron ore price continuing to drive strong free cash flow returns for the company, and similarly mineral resources on an expected dividend yield of 6%, so over 2% ahead of the market on a forward 12-month looking basis. Looking at our ETF RARI, which has a similar income objective but also a responsible investing universe, mineral resources added for the same reason, that relatively higher yield, but also adding Boral within the cyclical part of the market. And the reason for Boral's addition is that it scores very highly on ESG according to our input, and the reason for that is Boral's in an industry being building materials that has high sustainability risk, and Boral's management have done a very good job of managing that sustainability risk. And so when we assess the company based on our responsible investing inputs, it scores quite well and hence has been recently added to the portfolio. You can see here the impact of the recent reconstitutions for our ETFs, and third from the bottom, the large orange line showing our additions to the materials sector in RDV and a similar addition in RARI to the materials sector as well. Looking at the key takeaways now and the summary for today's presentation, markets and global economies remain in an early cycle phase after being reset as a result of COVID last year. The vaccine rollout that is continuing across the globe, record amounts of monetary and fiscal stimulus should continue to drive strong economic growth and push global markets into what is being deemed as the Roaring '20s. This market environment favours equities over bonds, and we expect equities to post relatively strong returns over the next 5 years, particularly outside of the US. Some of the losers of the last 3 to 5 years, we expect to become the winners of the next 3 to 5 years. Within equities globally, we favour cyclical positions, and that leads to a preference for value over growth. And that is similar in Australia, where we favour exposure to the banks. The Australian banks appear attractive on our framework of cycle, valuation and sentiment, and also provide investors with an above market yield of over 4% before franking credits are taken into account. And finally, our ETFs RDV and RARI have overweight positions in the banks and have recently added select cyclical stocks to the portfolio as part of their reconstitution in March. And we expect both of these exposures to benefit in our base case view of the world in stronger economic growth and move into the Roaring '20s. Thank you.